Good day, everyone, and welcome to our latest video report. I'm Dion Zakuski, Branch Manager, Senior Wealth Advisor, and Portfolio Manager here again with you. And now that we're well into September, we know this is a month that brings on a lot of change. There's changes in weather, household routines, there's new hockey seasons coming up, and also other things like elections. In today's video, we're going to check out whether the US presidential election is going to be news or just noise. We're going to look at how we're positioning portfolios going into the back part of 2024. And then we'll bring in our associate, Bon Jewell, who will talk to us about effective education account withdrawal strategies. So one of the most common questions we've been receiving lately has to do with the upcoming US presidential election. Usually it's in the form of, hey, it's really nice to see our accounts trending higher, but will this election cause a big downturn or disruption in markets? Now, with so much attention in mainstream media around this, it's easy to see why people have worries. However, we believe, along with our Scotia strategists, that it is much more relevant to focus on the stability and strength of the US economy rather than the ongoing media circus. For the first time in over 4 years, the American Federal Reserve recently cut interest rates by 0.5 percentage point, and this is to keep their economy in growth mode. This is important as further rate cuts are predicted later this year and into next, which should be tailwinds for share prices to move higher. Also, we see employment, corporate earnings, and manufacturing still expanding. All good news for investors. Really, the only scenario in the White House that could cause disruption would be if there's what's called a Republican trifecta. Now, what that means is if there's a majority in the House of Representatives, and then the Senate and the presidential chair flips over. This would pave the way for an increase in trade tariffs and deep tax cuts. Now, on the surface, tax cuts should be positive, but the US government would have less money coming in to service their debt. And we're going to look at a budget chart coming up next. So we went back to the 1980s to look at the US federal surplus or deficit. And we can see for about 2 decades, they ran a relatively balanced budget. Then it went deeper into the red in the early 2000s, and then very deep during COVID to the tune of about $4 trillion. Now, keep in mind, most governments in the world went into deficit during that time, all in an effort to prop up social programs. The good news is since then, that deficit has been cut in half, but is still pretty deep in the red, sitting at around $2 trillion. So in the end, the most optimal and likely outcome will be where one party has control of 2 out of the 3 legislative branches in the United States. Therefore, there would be checks and balances in place. So the answer really is that the US election will make for a lively and dramatic reality TV show, but as long as their economy stays on track, so should investment markets. So we just discussed how the election shouldn't have a lasting impact on investments, but there's still an element of volatility out there. Any data point coming out right now is heavily scrutinized, especially inflation numbers, which can result in daily swings both higher and lower than usual. Add in what's called the September seasonality effect, and this brings us to some interesting portfolio adjustments. Going back to late August, we made the decision to protect some profits in our models and rebalance portfolios. To look at the seasonality effect further, we'll use the following chart. So we pulled up a chart going back over the last 10 years of the world's largest index, the US S&P 500, to see the monthly returns, which ones are positive and which ones aren't. As we can see, on average, in late spring and early summer, you have almost a lock to make money. However, September is one of the only months that doesn't have a winning record, an average return of only 30%. Now, of course, you may have heard us explain that we hold a portfolio of investments, not the entire index itself. But with the seasonality factor coming up, a wider range of volatility, and solid gains already in place, we felt it was prudent to protect some of those profits and rebalance the portfolio. It's really about active management and risk control. From here, we're still optimistic long term and would look at any dip in the markets as an opportunity to add to high quality positions. Dropping interest rates, along with steady corporate earnings and economic growth, should allow for further gains. As always, if you have questions about your strategy or wealth planning in general, give our team a call anytime. Now, let's have Bon come in to talk about effective education plan withdrawals.
On our digital segment, we'd like to talk about RESP and RESP withdrawals. A registered education savings plan allows parents and grandparents to save for a kid's education. Government grants are received on the first $2,500 of annual contributions, subject to certain stipulations. The contributions and grants can then be invested tax-free until withdrawn from the plan. To withdraw from an RESP, you need to have a proof of enrollment. The proof of enrollment should be currently dated and on letterhead, should state whether the enrollment is full-time or part-time, as well as have the full name of the student as well as the program. It's easiest just to ask the financial institute for proof of enrollment, as this is a common request. Withdrawals are limited to $8,000 for the first 13 weeks, and after that, any amount can be withdrawn. Withdrawals are made up of three components: contributions, government grants, and then growth. It's important to note that the grants and government growth, the grants and the growth portion are taxable in the hands of the beneficiary, and they will receive a T4 slip. Typically, this is not a big issue because the student's income is low. In most cases, we would recommend taking from the grant and growth portion before taking from the contributions for this reason. But please speak to us in regards to your specific situation. As always, if you have any questions, please feel free to reach out. That's our report for today. Thanks for watching.